Hello, everybody. Welcome to Income Investors. My name is John Whitefoot, and with me today is Zulfiqar with a quick economic update. Our goal with these videos is not to tell you what to buy or sell, but rather inform you with what's happening. And if you want to read more about what Income Investors is all about, head to incomeinvestors.com, where you can find a link to the website in the description below. So, Mo, what have you got for us today?
Hey, John. Today, I want to talk about the yield curve. It's saying the stock market could be in a dangerous state and lots of volatility could be ahead.
Now, Mo, before we actually get into any details, could you actually explain in even for me, like in simple terms, yield curve is and why it really matters?
So in simple terms, yield curve is essentially a chart that plots yields on bonds of various maturities. Economists follow it closely because it has been a powerful indicator of what's ahead for the economy. Analysts and market strategists follow it because it can tell how stock market returns could look. Now, here's some yield curve 101. When the yields on short-term bonds are higher than the long-term bonds, then the yield curve is said to be inverted. When the yields on long-term bonds are higher than the short-term bonds, then the yield curve is said to be normal. For economists, when the yield curve is inverted, it hints that the economy could be headed towards a recession. In fact, yield curve has been one of the most accurate indicator of a recession. In the last few times the yield curve inverted, an economic slowdown followed a few quarters later. For analysts and strategists, whenever the yield curve goes from being inverted to normal, usually this is referred to as steepening, it is followed by extreme volatility in the financial world and the stock market.
Okay, now tell us what you're seeing.
The yield curve has been inverted since mid-2022. At the time of recording, yield curve has been inverted for 98 weeks. This is one of the longest period on record. Here's the thing though. Yield curve will eventually go on to become normal. It always does. This is like clockwork. Possible, in my opinion, that this happens as Federal Reserve starts to cut interest rates. And you might ask, why is that? This is because Federal Reserve's benchmark interest rates ultimately try to control what happens to short-term bonds, and this could change the direction of the yield curve.
So what happens when the yield curve changes direction?
So thankfully, this phenomenon has happened a few times, so there is something to look at and how it all plays out. Since 2000, the yield curve has gone from inverted to normal 3 times. Each time, the stock market showed dire performance. For some consideration, consider this. The yield curve bottomed in 2000. Around the same time, the stock market made a top. Then the yield curve started to steepen. Coincidentally, investors started to sell and major stock market crash was at hand. Say you held an index fund that tracked the S&P 500 between when the yield curve bottomed and it soared well above the normal territory, your investment would be down about 40%. Then something like this happened again in 2006. Eventually, the yield curve started to move higher. By 2007, the stock market had made a top. Investors again started to sell stocks and yield curve started to steepen further. By September 2008, a rigorous stock market crash started. Once again, if you held an index fund tracking S&P 500, through this time, your investment would be down by 30%. During the roughest time of the selling on the stock market, your losses would be much, much higher. And fast forward to 2019, something like this happened again. And it was relatively quick too. The yield curve became inverted in around mid-2019, then bottomed in September 2019 and changed direction quickly. By early 2020, the stock market made a top. In March 2020, a severe sell-off followed.
Okay, so with this information, what should investors do?
John, I can't stress this enough. I'm not saying we're going to see a stock market crash tomorrow, but it's a risk that shouldn't be overlooked, and especially if the rate cuts are on the horizon. Yield curve has proven to be a great indicator of how stock market returns look, and I have to ask, could the pattern repeat itself? I also think that predicting exact top and bottom is impossible. You can only tell when the bottom in the yield curve or the top in the stock market has formed once it has happened. Betting against the stock market could turn out to be a horrendous trade. I think the best strategy right now would be to be super selective when picking opportunities and being careful with capital allocation. Plus, focusing on quality versus quantity. In case the stock market does turn, quality companies with careful allocation could protect the portfolio from severe losses.
Thanks, Mo, once again for your valuable insights. If you want to check about what Income Investors is all about, you can find the link to our website in the description below. While you're there, you can sign up for our free special report on 3 income stocks to own today. One of those stocks currently has a dividend yield of 12.7%. We'll be back with income picks soon, so stay tuned and don't forget to like the video and subscribe to our channel. Goodbye for now.